Okay, Friday, March 11th, 4:15 p.m. Start a March break for those
Yeah,
of us
that's right.
that are still in the mix. Are you excited?
Kids are excited that when they go back to school, it's no mask. No mask.
Oh, right.
Yeah,
That's big,
it is big.
right? That's really big.
Mhm.
So, yeah, if that'll make it feel like the pandemic's over, won't it?
It will.
Yeah. Between that and everything that's going on with Russia and the Ukraine, people forget all about it, won't they?
They definitely will. I talked to a client in Vancouver today. They said they've lifted the mask requirements today there. So,
Okay.
yeah, so feeling different.
It's going to be, it's going to feel different, isn't it? You're going to have to go out. You're going to have to start brushing your teeth again.
Yeah, exactly.
You know, right? Okay. Going to need a breath mint here and there.
That's it.
All right, let's get into it. What do we, another week of, what is that, 5 weeks in a row? I think I read that today on BNN. Dow 500 notches its fifth straight week of losses.
Markets.
Yeah.
Yeah, it's been grinding down to the down. And so as I look at kind of the major indices, you got NASDAQ here now year to date, minus 18.5. You got small caps growth down, 14%. And you got S&P is, at least in Canadian dollar terms, is down 11.6% year to date. So yeah, it's been grinding sideways to down, and you've had bonds, they are relative performers right now, not on the positive side of the board yet either, but you're looking at the short-term bonds down 1.6, midterm, which would be 3 to 7 years, down 3%. And then if we look at the 10-year, 10-year is minus 3.8. So huge relative outperformers, not quite on the positive side of the board that we want to see and hope to see. But yeah, stocks have been under serious pressure, particularly growth stocks.
Right. So that being said, what did you get up to this week in the portfolios then? All that being said.
Yeah, so yeah, it's been one of kind of the start of the year as we talked, right? Sell-off started right out of the gate, kind of sold off pretty hard in the end of January. Wasn't quite positioned where I wanted people to be. Got a rally, did get the opportunity to reduce some risk into early February, sold kind of pure exposure to S&P at that point. It's down about 7% since then and added bonds, which was kind of an 8% better decision for clients. So since then, it's been more of a let's really kind of prune and wait and see. Nothing huge this week. Sold consumer staples, XLP, and bought EDV, which is extended duration US bonds. And so where the last couple of days we had a couple of days of rally, sell off, a couple of days of rally, sell off. And so S&P had one day where it was up 3%, and then proceeded to sell off again. I mean, these are indicative of bear markets. And so what's interesting too is volatility is elevated, but it hasn't spiked. And so typically at the kind of the end of a bear market, we'll say, you get kind of that spiking where you get, like we saw in 2020 and 2018, is you get volatility kind of 50 to 70. And so we've been trading in that kind of 25 to 35 range, at least for broad markets. And so we haven't seen that big spike. Julian Brigden put out a good research piece today, kind of on volatility and leverage and how much powder we'll say the leverage hedge funds have to put to work. And it appears that we're at kind of a point here where we're either going to get volatility to break out, but it appears that most of these hedge funds don't have much liquidity right now. So we're at a pretty precarious time. So as a result of that, anything I did this week was really kind of risk reduction, added a tiny small position in Capri Holdings, which we've traded on and off in early 2021. That would be kind of a luxury company that they had earnings come out, stock kind of gapped down 25%. So we bought it there, but again, initial small position. Consolidated some of the other holdings into Cancord Acquisition Corp, which is Circle. So they did an announcement mid-February, if people are watching it, where there's kind of a revaluation because Circle's gained a lot of traction and their business is worth a lot more than when the original deal was struck. But Concord and Circle still agreed, but they changed the terms of the agreement. So I added to that a little bit this week as well. But generally, it's a let's continue with caution. I do think these bonds are going to work and continue to have a lot of questions around why. So we can talk about that a little bit.
Okay, great.
Yeah.
All right. Anything else of note? I mean, there was lots of stuff in the news, and anything else that grabbed your attention this week? Actually, before we get on to that, if anybody has any questions, certainly put them in the Q&A down below here.
Yeah.
Yeah. So sorry. Go ahead. If anything of note that's grabbing your attention this week.
Yeah, there's, I mean, so much information coming out this week. And we saw the ECB earlier this week, which is kind of noteworthy. They sounded quite hawkish still, which is meaning that they're going to raise rates, or at least that's what Lagarde said this week, which was quite a surprise because of the turmoil that Europe's in right now. They did at the same time issue more debt, we'll say, for energy relief and or I guess support for the current position that Europe's in. So that was a bit of a surprise. The FOMC kind of stayed on their hawkish tone where they're going to raise rates. And so, you know, those things continue to be a bit of a surprise given what's happened in markets, where you get kind of NASDAQ down 25% from its highs. So it continues to be a surprise given what's happened in markets, particularly because the Fed for the last 20 years, anytime we've got kind of 20%-ish sell-offs is when they've started to change their tune, but they haven't done that yet. So next week will be a big week.
Gotcha.
Yeah.
Let's, why don't you give us the definition of hawkish and dovish?
Yeah.
I don't know. We're trying to be a little more novice friendly here.
Yes. So hawkish means they're continuing of the view that the economy is hot. They're staying with the view that things are good. As a result, we need to tighten financial constraints. So we need to raise rates and stop buying bonds. So we want to kind of shrink what we're doing. That'd be a hawkish tone. Or a dovish would be more things are actually challenging, so we're going to cut rates and you know, continue to expand the balance sheet, give out money to stimulate the economy. So their tone continues. We want to fight inflation. Employment's excellent. The economy is excellent, and that's kind of their wording. So that would be, I guess, the definition from if that makes sense.
Yeah, makes perfect sense.
Yeah.
All right. Well, let's. Anything you want to say before we get into the Ben's charts? Or is it time?
Yeah, it's time. It's time. I think that the only other kind of frustrating thing that I've seen this week is the politicians are blaming everything on Putin, and it's Putin's fault that we have inflation.
Oh.
Which certainly is not the case.
Yeah.
Yeah. Okay, so let's get that here. All right. So I don't think I sent this out in the daily. It was one that I grabbed this week that was a definite shock moment. I think it might be from The Economist. I don't recall exactly where it came from, but you know, well, we are, you know, where I feel anyways is that the developed world is fighting about, you know, who gets this piece of the pie, and kind of small thinking and kind of that contractionary thinking. For people I've mentioned and referenced Mark Yusko a number of times where he comments on, China's playing Go, China's playing the long game, and everyone else is playing checkers. And so this is an interesting view at, the year 2000, which country share greater trade with China. And so obviously the year 2000, which we see here. And then if we look at what that graphic has become in the past 20 years, and you may think 20 years is a long time, but on the scale of things, this is massive expansion that China has been going pretty much everywhere in the world, ex-North America, and expanding their trade. And so as we think of what's happening right now, there's a lot of focus around what Russia and Ukraine's doing, and it's certainly terrible to see what's happening. But if we followed this week, China has come out and said, we're willing to buy all of the exposure to the companies that the West are selling. So Rosneft and BP of dumping their position. China said we're willing to buy it. They're stepping in and being extremely advantageous and investing in Russia and these companies and putting themselves in a much better position long term. So you may love it, you may hate it, you may despise what they're doing, but this is reality that's happening right now, and I think we need to continue to pay attention to it, and I hope the world leaders pay attention to it as well.
Yeah, that's a great one. That's kind of shocking for sure. 20 years isn't a long time to take over that much real estate for sure.
So this is a chart also worth thinking about. And so this has some to do with ETFs and market cap and really how the indices have changed over the last 30 years. But certainly noteworthy. And this was, as you can see, a couple of weeks ago. And since then, the chart's gotten worse. But this is most 52-week lows in the NASDAQ composite. So where I've been talking about at least late last year, there's those 4 or 5 companies that were driving kind of the majority of returns in the NASDAQ. And so beneath the surface, it was ugly. And now we've seen a crack and some of the bigger names have come down. So you have more companies than we've seen in the last 30 years that are touching 52-week lows in the NASDAQ, and the NASDAQ's only down 25%. So when we look at this, is it an opportunity? Is it a risk? Is it something to think about? Well, it's certainly something to continue to think about. I think through this rubble that's going to come in the next multiple months, there's going to be some great opportunities for the next decade. But this is just a testament to the damage that's been done in the broad market if you're in the wrong places.
Wow. Yeah, like you said, that it does look like they're kind of a scary chart there, but there certainly could be more opportunities that come out of that for sure.
Yeah, like Shopify, which we've talked about before, they're down kind of 70% since November. Is their business worth 70% less? Probably not. But the market continues to be putting into lower levels for any of these growth companies. So I'd say important to pay attention to what's happening now. And that's what I'm trying to spend time on. Let's preserve and protect, but be in a position of power to take advantage of some of these opportunities.
For sure.
Yeah. So I try to leave it last with the Web3 or the crypto, and just a little bit about what we're seeing here. This is really a view of, I know it's not a super long historic chart, but it's 10 years, which is the majority of when Bitcoin's been trading. And it's a worthwhile view at just how Bitcoin price has been changing. And we've hit various times where we get this consolidation and the supply of Bitcoin really reduces. And we're starting to see kind of a similar period in setups where we get kind of a similar overlay to just think about how this has evolved over time. Raul's been talking this week, Raul Pal from Real Vision, just about Bitcoin, and people are getting frustrated that it's not trading like gold and trading with a bit more risk than it. And so it's a really new asset class still, but it's important to think about the time frames as well. So, you know, if we're consolidating in this 30 to 50 or 40,000 range, it's a pretty wild swing, of course, but it's very important that we think about it from a longer-term perspective. It still has the properties of the kind of the Web 1.0, and it takes a little bit of time to base and evolve. So I think we're getting close to those levels, and similar as I believe most of the damage is done there. So some pretty good opportunities from a long-term perspective.
Gotcha. How is it? Has it been? We've talked about this before. Has it been correlated to anything? Has it in the last little bit here?
Yeah, it's been highly correlated to risk assets. So that would be anything market related, but you know, it trades at kind of 5 times the standard deviation of the markets. So when you look from a correlation perspective, it trades in lockstep with risk assets right now. It's actually traded similarly to tech. So volatility continues to come down. But yeah, it hasn't been an uncorrelated asset, with the exception of about a week and a half there where Ukraine and Russia war started, and you got a rally as individuals move some of their money out of their local currency and into Bitcoin. But now it's kind of stabilized.
All right. 3 good charts there, Ben. Great work.
Thanks.
Okay, no questions yet. So let's keep rolling.
Mm-hmm.
What's in the crystal ball this week? What do we coming up for next week?
Yeah, so I continue and I tried to think about the best way, because I've talked about bonds a lot in the last, I'd say 8 to 12 weeks. And one of the questions that keep coming back to me is, you know, the central banks are talking about raising rates. Why would you be buying bonds if they're talking about raising rates? Well, I mean, the move happens when they say they're going to do it, not after they've done it. And so because they've said they're going to raise rates, bond prices have already gone up in anticipation of them doing so. And so when we think about the combination of, you know, what's the economy doing versus like what are central banks likely to do? And so, you know, the 1-year Canada bond right now is 1.46%. And so right now, if the central bank in Canada raises another, we'll say 4 or 5 times, then we'll get just to the level of where the bond market is right now. And so they control that short end, that 0 to 2 years. So the probability that they can do that is, I would say, I'd put it at 10%, because if they raise rates that many times, we're going to have a severe recession in Canada. And so similar to the US, you know, the US 1 year is 115. So if they raise 6 times in the US, again, we're going to have a severe recession.
Right.
If we have a severe recession, then the longer bonds, which is where we have more of the money, well, yields will go down, prices will go up. And so the US 10-year right now is at 2%. Canadian 10-year is also about 2%. When they have to change and pivot, those yields are going to go down. And I think they go down by a lot, like probably 50%. And so the bonds in your portfolio can go up somewhere between, you know, 10 and 40%, depending on where you are on the curve. And so we haven't seen that move yet. But given what I expect, which is slowing GDP and much quicker slowing GDP because of higher costs with oil and energy and things like that, you know, that the slowing growth is going to come faster. And so at some point, this comes into the market, and we start to see it priced in more effectively, and that's when the bonds will start to rally. And I'd expect that to happen here in the second quarter.
Okay, great.
Yeah.
All right. Still no questions yet. So kind of last call for those. Anything you want to wrap up with?
So I'd say the last thing is the, we're in an environment where we're trying to control the macro, which we can, and we continue to focus on that. But you have this geopolitical risk that continues to overhang the market, and so the UK and Russia, as we've spoken about, I think this is week 3, potentially week 4, that it continues to be the driver of all things over the weekend, and so this is. Continues to be an asymmetric risk. So if they come to a complete settlement, they pull back, you get a massive rally in stocks, you get a massive sell-off in commodities. So those kind of asymmetric risks, trying to not really play too much right now. It's something that you can't really prepare for. So we have exposure from the perspective that we continue to play defense with US dollars and bonds and some gold. But that's really kind of the one thing that causes me the most amount of angst around what's happening. The macro I'm certain of, but the political risk, continues to be something I try to pay attention to, focus on. But when and if that agreement comes, it's going to be really kind of a small short-term shock until the focus comes back to what's happening in the real economy.
Gotcha.
Yeah.
Well, it's a great way to end it off. Thanks for everybody for tuning in, and we will see you next week.
Sounds
one more
good.
thing.
Yeah,
Okay,
if everyone's still there, can we
Yeah.
can I say something I forgot?
Yeah.
Yeah. Next week, obviously March break. We're gonna do the roundup on Wednesday. And I will be off Thursday, Friday. So we're gonna do a kind of shortened week, midweek roundup. So we will make sure that goes out and gets communicated in the daily.
And that roundup will be with you and Joy, because I won't be here on Wednesday.
That's right.
I just thought of that. Okay, so Wednesday roundup next week. So it'll be a short week.
Yep. Sounds good.
All right. Perfect. Thanks.
Thanks.
Bye.
Take care.